In this video presentation, we are going to practice analyzing transactions and recording them in our transaction analysis. Here is our list of transactions or economic events that we're going to be looking at for Linville Canyon Cooking School during September, its first period of operations. Remember, when we're doing transaction analysis, the first thing we want to do is to identify which accounts are impacted and whether they increase or decrease. As a check, we want to make sure that after each transaction, our accounting equation is still in balance. So to get us started, I have provided the account names and classified them as assets, liabilities, and equity. You may want to pause the video right now and prepare your own transaction analysis in Excel. If you'd like, you could go ahead and go through the transactions and see how each of them impacts these accounts and whether you're able to analyze the transactions and keep the analysis in balance. But we'll go through each of the transactions one at a time. So the first transaction is that we're issuing common stock in exchange for an investment of cash by our shareholders. So when investors or stockholders purchase shares of common stock in our company, they are purchasing ownership interest. In general, they're going to be transferring cash into the business, and the business is going to issue shares of common stock in exchange. So the two accounts that are impacted in this case are going to be cash, which is an asset, and common stock, which is an equity account. In both cases, the accounts are going to be increased. We increase the cash account when we receive cash, and we increase the common stock account when we issue shares of stock. So we're going to record this transaction in the analysis as an increase to cash of $50,000 and an increase to common stock of $50,000. Cash and common stock are on opposite sides of the accounting equation, so when we increase an asset and an equity account by the same amounts, our equation is going to stay in balance. The Excel file with the transaction analysis is the last slide in this presentation. Transaction 2, we're borrowing cash by signing a note payable. So once again, we're going to receive cash and we're going to increase the cash account. And in our note payable account, we want to show that we owe this amount of money. So cash is going to be increased because we're receiving cash, and the note payable, which is on the opposite side of the accounting equation, is also increased. So we have an increase to an asset account of $25,000, an increase to notes payable of $25,000. Our third transaction is that we are buying equipment in exchange for cash. So in this case, we are paying out cash. So when we increase our cash account when cash is received, we're going to decrease our cash account when cash is paid. So in this case, we have two asset accounts, cash and equipment. Cash is going to be decreased and the equipment account is going to be increased by $35,000. So we have a net change of 0 to our assets account and no changes to liability or equity, so our accounting equation is going to stay in balance. Our fourth transaction is that we receive cash in advance of the performance obligation being satisfied. So remember our revenue recognition principle that says that we recognize revenue when the performance obligation is satisfied, regardless of when the cash is received. So if the performance obligation hasn't been satisfied here, we are not going to record revenue. What we're going to record is unearned revenue, which is a liability account. So we're getting cash, so we're going to increase our cash account again, and we want the liability account, unearned revenue, to show the value of the services that we owe. So we are going to increase cash by $2,200 on one side of the accounting equation and increase the liability, unearned revenue, on the other side of the accounting equation, also by $2,200. So our accounting equation is staying in balance. Transaction number 5, we're going to collect cash at the time the performance obligation is satisfied. So in this case, we are receiving cash again, so we want to increase cash. But in this case, we are going to recognize revenue because they tell us that the performance obligation has been satisfied. So we know that when we're doing transaction analysis, we record revenues as increases to the retained earnings account. So in this case, we're going to increase cash by $11,500 on one side of the accounting equation, and we're going to increase retained earnings by $11,500 on the other side of the accounting equation so that it stays in balance. Transaction number 6, we're going to pay rent for the current month. We've talked about how if we make an expenditure and it only benefits the current period, it gets recorded as an expense. On the other hand, if it benefits future periods, we record it as an asset. So in this case, it clearly states that we're paying rent for the current month, so it is rent expense. We are paying out cash, so our cash account is going to decrease. And while revenues increase retained earnings, expenses decrease retained earnings, so the other part will be to decrease retained earnings, in this case by $2,900. So we're going to decrease cash by $2,900 on one side of the accounting equation and decrease retained earnings by $2,900 on the other side of the accounting equation. In this case, transaction 7, we have a payment or an expenditure that benefits future periods. So transaction 7 is paid the annual insurance premium. So the expenditure benefits future periods and therefore meets the definition of an asset. So in this case, we have two asset accounts, cash and prepaid insurance, that are going to be impacted. We're paying out cash, so cash is going to decrease. We are acquiring an insurance policy, which is an asset, so we are going to increase prepaid insurance. So the transaction is for $4,800. So we're going to decrease cash, one asset, by $4,800 and increase another asset, prepaid insurance, by the same $4,800. Transaction 8 is a purchase of supplies on account. We've discussed how supplies is an asset. Most of these expenditures are going to benefit future periods, so we record them as supplies an asset rather than supplies expense. We're buying the supplies on account, so we're going to have a liability, accounts payable. Our supplies account is going to be increased by the cost of the supplies, which is $3,500, and our accounts payable is going to be increased by the same amount, so that we now show a liability, show that we owe $3,500. One's on one side of the accounting equation, the other's on the opposite. Our accounting equation stays in balance. Transaction number 9 is that we are going to pay a dividend. There are other types of dividends, but we are going to assume here that this is a cash dividend, so we are paying out cash. And when we pay out cash, cash is going to be decreased. Revenues increase retained earnings, expenses and dividends decrease retained earnings, so the other account that's going to be impacted here is retained earnings. It is going to decrease by $2,500, so we have a decrease of $2,500 on each side of the accounting equation, and our equation stays in balance. Final transaction is that we're going to pay an employee. Our employee has worked. We have incurred salary expense. We are paying them in cash. So once again, cash is decreasing. by, in this case, $4,100. Retained earnings on the opposite side of the accounting equation is also going to be decreased by $4,100. So we take a look at how that all shakes out here. Here's what our transaction analysis looks like. What I would recommend is that you figure out the balance in each of those accounts. In most cases, it's not going to be super complicated. And then write out the accounting equation. What are total assets, total liabilities, and equity after these transactions have been recorded?